right, peoples, let's get started here. We have Amazon and AMZY. So no trades were put on, no shares were bought. Amazon was up just a little 0.38 of 8%, and AMZY did a little better, up 0.44 of 1%. So I can tell you the whole gist here, it's Amazon's having a nice month, collecting good money. It all comes down to earnings on whether they keep their weeklies or not. I believe it's after market, but it clearly is on August 1st. I'll double check it by tomorrow's update on after hours or not, but I'm 90% sure it's after hours. So that determines everything. Let's go take a look at weekly and see how we're doing on the weekly in terms of how far away we are, right? That's really the purpose of this weekly. That, and sometimes I do technical analysis on the chart. So our calls are out at 195 and 197.50, and we're trading at 183, but they're holding a lot of time premium with 4 days. And it's obvious that it's looming on the earnings, right? So the earnings aren't until Thursday. So once they're declared in the evening, it's all about Friday trading. And if it even if it moves up, my guess is it moves up $10, right? It moves up to 195, 197. Well, that's where our calls are. So we're still winning at those levels. Now, if it's how the market has the Mag 7 priced to perfection. So they may hit their earnings, go by their earnings a little bit and say, well, we do see some slowdown on consumer spending, on our prime, on this. But generally, the stats look pretty good as far as what I can tell on Amazon. So this will be an interesting big company reporting to tell us what's the trend as well, because my probability is that we get recessionary at some point. Again, I've always said September is when the institutional money is back and you'll see the volume come back into the market, and the volume will tell us which way it wants to go. Right now, the volume is retail, and if retail's buying, then the market goes up. Um, if it's selling, it goes down. I mean, those are obvious, but the volume is really missing for this last 2, 3 months worth of trading. And so when volume comes back, we'll get a better indication. Okay, so let's look at our holdings because this really describes what's going on at a much greater depth. It just jumps out, and I've tried to do what I can to make it. So again, a little bit of education. So we have a synthetic. What is a synthetic? People hear that term, newbies coming in. I'm going to give you a minute and a half. A synthetic is a way to simulate but have the same effect monetarily through options of owning the stock. The reason they don't want to own the underlying stock, like some covered call strategies, is because by definition, an ETF can't have greater than 10% of their money in any single stock. So what do you do when you have a single stock fund and it's an ETF? Well, then you don't buy that stock, right? Because very quickly the money would get greater than 10%. So you put all of your capital in treasuries as collateral. You always need collateral when you're writing option. If you're writing naked calls like they do, but on the synthetic, they buy a call and sell a put. Sometimes those collect the same amount of money. They collect on one and spend on the other. It's break even. Sometimes they actually collect more cash flow, right? They buy cheaper, sell higher on the put. And those vary, but if you're doing something like that, where you might owe money at the end of the option expiration, you have to have a lot of collateral, basically cash sitting there to settle with them. Okay. So they have that scenario going on, and that's what a synthetic is, completely a bullish bet. I bought a call. It only goes up when the underlying stock moves up. I sell a put. It's also a bullish bet. If the stock drops, you're going to have, you're going to have that stock put to you at a higher price, right? If you sell a put for, $200 and the stock drops to 140, they're going to sell it to you at 200. So you guaranteed yourself a loss. But if you sell a put for $20 on 200, once it gets to 200 and moves up at expiration, you don't really owe anything. These electronic settlements that they do cost them 2 or 3 or 4 cents because they have to electronically settle. They're not like retail where you just let it expire worthless. So just a point to tell you without getting into that. All right. And then what else did they do? So that's their long stock. If that's all they did, we would do exactly what the underlying did. Okay. But if the underlying goes flying up 15% in a week, we're probably only going to go up 5% because we're what's known as capped. We're selling these naked calls. They're naked in the sense that we don't own the underlying stock, but they're referred to as a covered call strategy because we're long the stock by mimicking it with these synthetics. So they call it a covered call strategy, but it's not a true covered call in that they own the underlying. They just mimic owning the underlying with the synthetic. So these things, as long as, they'll write them 3% and they're writing a 4%, they vary. But if the stock just goes up a little bit, they get to keep all that income. And for an income fund, that's a great way to pay out. And if the stock is just ebbing up slowly over time in the synthetic, then you're making money over there when they change those out every month or two. But these get changed out once a week and cash settled. Okay, so that's a background on that. So what happened? 0 there, that's from last time. So we finished at 2054. 2063. Let me go back to that. You always, a lot of places. Okay, and fair value, let's make sure I did that, but I did. Okay, fair value is 1750. Boy, I'm thinking back to Tesla for a minute. 2060. So we're 3 cents away, right? Not a big deal. 3 cents premium on our price versus net asset value. In other words, all the things they own and owe added up, liabilities, assets, blah, 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 and then how many shares, right, by the share count. So 2063. So we're good. This is a visual that I put in, and I just do a little 4-day visual. So when we're moving up a little bit, our synthetic that's at a loss, okay, because we chose a high strike price, but it's losing less as we go. So that's a good trend. And as I said, it all comes down to this. We collected 1.566 million. Okay, and when I mean collected, they write a call. They write what, they refer to as a covered call strategy. They write a call. Technically, it's a naked call. They don't own the underlying. They write that call and they get money as soon as they write it. They sell 3,070 contracts for whatever price, and I put that in July and I track it over here. And then this tells me what's it worth right now. Well, a lot of this money, it's 195. The stock's trading at 183, 182. So all of that is time premium, all based on that earnings coming out on 8/1. This thing will drop like a balloon on Monday if it's on Thursday. After market, if this thing just hovers around 185, never gets to 190, this thing's going to open up on Friday at like 15, 20 cents. And they'll be able to buy it back for a penny or two. And the same thing with this. This is even higher, right? We're trading at 183. There is no premium being above the weekly. And they, at the end of the day, can buy it back for pennies if it doesn't reach what it's written at, these strikes. So we're well below the strikes, right? We're down at 183.20, but earnings is looming. So it's all going to come down to earnings. All right, guys, let's go to payouts. So we've collected 70 cents. Now, I haven't been doing this fund that long, right? I just started at the beginning of July. So I saw what the distribution was. I've been collecting all the stats to see what they're collecting this month, but I can't tell you how they've treated it before. I can go back and look at what they paid, but I don't always know what they collected in the past. So typically, I've done enough of these. I'm doing 6 now, and I've been doing some for a long time. So they will pay sometimes as much as they collect and even more if there's a reserve carry forward. Well, I don't have any stats on that because I haven't been doing it long enough. But they have 49 cents that they've collected here. And then by adding this amount of money, they have a total of a net income of, we use negatives here to create the money. So don't worry, it's not really a negative, right? Debits and credit. So we have 8.5 million shares. So if this income was 8.575, you'd have exactly $1 in total. So it's basically saying 49 of the 70 cents is coming from these weeklies. And then the other 21 cents of the 70 is coming here. They're both negative numbers, which is what we want in this particular accounting within this payment section. We've got 9 days till we pay, but more importantly, we have 7 days till they declare. So this Friday, we'll be able to roll out of the current ones. We may have to buy them back for more money than we paid if this thing flies past 195, 197, but we'll get one more shot at adding money. But remember, this money today is including all of this money that we collected. Right? It includes the 1.5, so we don't want to lose that. So right now, the status of these is we have 70 cents to pay out if they choose to pay it all out. We could have 80 or 85 cents at all, more likely we're going to be in the high 70s. If I had to go with a prediction right now, obviously it's likely to be between 70 and 80, because if this thing blew past the weeklies and we lost money, then we would make it up over on the synthetic, and they would roll that synthetic, and we'd have enough money. So I'm saying somewhere between 70 and 80, probably not far from what we paid. All right, guys, that's what I got for you. So Bruce out. Again, not financial advice. I'm not a financial advisor. Before you make any financial decision, you should always consult your financial advisor. All right, guys, have a great one. Bye for now.